Here's a signal worth your attention. The average small business waits 28 to 34 days to get paid, but your bills? They don't wait. If you've ever been profitable on paper but still scrambling to make payroll, you already know this problem. Today, we're breaking down exactly why it happens. And more importantly, the simple forecasting tool that can help you see cash crunches coming before they become emergencies. Quick note, this is not financial advice. Let me paint you a picture. You just landed your biggest client yet. The contract is signed. You deliver the work. The invoice goes out. Now you wait and wait. Day 14, nothing. Day 21, still nothing. Meanwhile, payroll hits in 3 days. Rent's due next week. This is the cash flow timing gap. It's invisible on your profit and loss statement, and it takes down profitable businesses every single day. Here's what the data shows us about this timing mismatch and what you can actually do about it. To understand this problem, we need to talk about something called the cash conversion cycle. It sounds technical, but the concept is straightforward. The cash conversion cycle measures how long it takes for the money you spend on inventory or services to come back to you as cash from customers. For most small businesses, this cycle has 3 parts: days to hold inventory, days to collect payment, and days you have before paying your own suppliers. The formula is simple. Days inventory outstanding plus days sales outstanding minus days payable outstanding. That equals your cash gap. But here's where it gets real for small business owners specifically. Your customers have more leverage than you do. They often dictate payment terms. A big client might insist on net 60 terms. That means 2 full months before you see a dollar. Your landlord, though, expects rent on the 1st. According to ScaleLab CFO research, the average small business waits 28 to 34 days to get paid. Meanwhile, critical expenses are due within 0 to 15 days. That's a minimum gap of 13 days, but often more like 3 or 4 weeks, where you're covering expenses with money you haven't received yet. As ScaleLab CFO puts it directly, bills move faster than payments. That's the fundamental cash flow challenge every small business faces. This is why profitable businesses fail. Your income statement shows you made $40,000 last quarter. But if $30,000 is still sitting in accounts receivable, you can't spend it. Now, most business owners track their finances monthly. You review last month's numbers, maybe compare to budget, and move on. The problem? Monthly reviews look backward. They tell you where you've been, not where you're going. By the time a monthly review reveals a cash problem, you're often already in it. FocusCFO analysis describes this as the monthly fog. When you only look at what happened last month, you can't see developing cash crunches until they're already upon you. This is why FocusCFO and other financial experts recommend a different approach, the 13-week rolling forecast. It's designed to clear that monthly fog. A 13-week rolling forecast projects your cash inflows and outflows over the next 3 months. It gets updated weekly, so you always have a fresh view of what's ahead. Think of it as a rolling window. Each week, you add a new week to the end and drop the completed week from the beginning. Your forecast always looks 90 days forward. Why 13 weeks specifically? It's long enough to spot problems before they become emergencies, but short enough to forecast with reasonable accuracy. You can reasonably predict what payroll will look like in week 9. You have a good sense of which invoices might actually pay by week 5. Beyond 90 days, things get murky. As FocusCFO describes it, this 90-day horizon clears a monthly fog by shifting your focus forward. You're not reacting to problems, you're anticipating them. The research from CEO's right hand confirms this. Managing cash flow as an ongoing discipline means reviewing your forecast weekly, not monthly. Weekly. Weekly reviews catch small problems before they become big ones. That invoice you expected in week 2 that's now pushed to week 4. You see it early enough to adjust. Building this forecast doesn't require fancy software. A spreadsheet works fine. The key is consistency. Same time each week, same process, same honest look at what's coming. Here's your first action step. Open a spreadsheet this week. Create 13 columns, 1 for each week. Label them with actual dates, starting with the current week. In the rows below, list your cash inflows, expected customer payments, any recurring revenue, loan proceeds if you have financing coming. Be specific about timing. Then list your outflows, payroll dates, rent due date, Insurance premiums, subscriptions, vendor payments, loan repayments, everything that takes cash out of your account. The math is simple. Starting cash plus inflows minus outflows equals ending cash for each week. That ending cash becomes your starting cash for the next week. NAV research points out that monitoring your cash conversion cycle helps create a form of internal financing. You're using time as a tool, not letting time use you. When you see a cash crunch coming in week 7, you have 6 weeks to respond. You can accelerate collections, delay a purchase, arrange a credit line before you desperately need one. According to NAV, tightening receivables and negotiating favorable supplier terms can significantly improve your cash position. But you need visibility to know where to focus. Here's a practical move you can make this month. Review your payment terms with your top 3 vendors. Ask for an extra 15 days. The worst they can say is no. On the receivables side, IDEA Financial notes that many businesses are using invoice financing to improve liquidity. This means selling your invoices at a discount to get cash immediately. Invoice financing isn't free. You're trading a percentage of the invoice value for speed. But for some businesses, the improved cash flow is worth the cost. The key is knowing when it makes sense. If you're growing fast and need to cover operational costs, financing receivables might be smarter than missing payroll. CEO's right-hand research emphasizes building reserves during good months. When cash flow is positive, set aside a fixed percentage for a rainy day fund. Your target 2 to 3 months of operating expenses in reserve. You don't build that overnight. Start with 2% of revenue and increase it as you can. Here's another quick win. Stop batching invoices at month end. Send invoices the day you deliver work. Every day you wait is another day added to your collection cycle. Think about it. If your customer takes 30 days from invoice date to pay, invoicing on day 1 versus day 15 means getting paid 2 weeks earlier. That's meaningful. You can also offer early payment discounts. A 2% discount for payment within 10 days might sound expensive, but run the numbers on your specific situation. If that 2% discount gets you paid 20 days faster, and you can use that cash to take your own supplier discount, the math might work in your favor. Calculate your own cash conversion cycle this week. Days inventory outstanding plus days sales outstanding minus days payable outstanding. Know your number. PEC's research confirms that improving working capital often comes down to timing optimization. Small changes in when money moves can create significant breathing room. If you can push a major payment from week 3 to week 6, that's 3 extra weeks of float. If you can pull an expected payment from week 6 to week 4, that's 2 weeks gained. IDEA Financial's research on 2026 trends shows that small businesses with active cash flow management are better positioned to pursue growth opportunities when they arise. When you can see 3 months ahead, you can say yes to that big order knowing you have the cash to fulfill it. You can hire ahead of demand. You can invest in equipment before you're desperate. If you're finding this helpful, consider subscribing. We put out episodes like this regularly, focused on the practical signals that actually matter for small business owners. Let's talk about what happens when your forecast reveals trouble ahead, because it will eventually. That's actually the point. You want to see problems early. When you see a negative week coming, you have options. Option 1, accelerate receivables. Follow up on outstanding invoices. Offer a small discount for immediate payment. Option 2, delay payables where you can. Call vendors before due dates and negotiate a brief extension. Most will work with you if you communicate early. Option 3, tap a line of credit. If you have one, this is what it's for. If you don't, seeing trouble early gives you time to arrange one before you're desperate. The worst time to ask for credit is when you urgently need it. Banks can smell desperation. Arrange your safety nets during calm weather. CEO's right hand emphasizes that reserves built in good months protect you in tough ones. The 13-week forecast shows you which months are likely to be good and which might be tough. Set a rule for yourself. Any week where ending cash exceeds your target reserve by more than 10%, that excess goes into savings, automated if possible. This might feel like overhead at first. Another thing to track, another task for your week. But business owners who've been through cash crunches know the value of visibility. The hour you spend each Friday updating your forecast is an hour that might save your business someday, or at least save you from the stomach-churning panic of unexpected shortfalls. Let's bring this back to the core signal. Cash flow timing is the invisible killer of profitable small businesses. You can do everything right: land great clients, deliver excellent work, show healthy profits on paper, and still get caught short when bills come due before payments arrive. The 13-week rolling forecast is your early warning system. It doesn't prevent cash crunches, but it shows them coming while you still have time to respond. Set it up this week. Update it every week. Your future self, the one not scrambling to make payroll, will thank you.